Welcome back to the deep dive. Today we're digging into AutoZone, specifically their latest financials, fourth quarter, and the full fiscal year 2025, which just wrapped up at the end of August. And there's a real puzzle here. You look at the sales, and they seem, rock solid. But then the profit picture, well, it doesn't quite line up. Okay, let's unpack this. Our mission is figuring out what drove that underlying sales strength and what big strategic bets they're making that might be holding back profits right now.
That tension is really the whole story, isn't it? And it's exactly why listeners need to grasp the difference between the standard GAAP numbers and the company's adjusted figures. See, we're looking at the end of their fiscal year, right? But FY24 had an extra week, a 53rd week. So if you just look at the raw GAAP numbers...
Comparing apples and oranges.
Exactly. It's meaningless for year-over-year comparison. We absolutely have to use their adjusted numbers to compare 52 weeks against 52 weeks. That's the only way to see the real trend.
Okay, got it. So let's start with that top line, the sales in Q4. That's the 16 weeks ending August 30th. Net sales were, what, $6.243 billion?
Correct. Which sounds good.
But the adjusted number is even better, right? Taking out that extra week from last year.
Makes a huge difference. Adjusted net sales were up a really strong 6.9%. That tells you the underlying business has some serious momentum.
Almost 7%. Wow.
Yeah, it really shows that, people are still fixing their cars, demand is strong. And if you look at same-store sales, or SSS, that's just stores open at least a year.
Right, the core performance metric.
Total company SSS, using constant currency, was up 5.1% in the quarter. Domestically in the U.S., it was also strong, up 4.8%.
And internationally, I heard that was even stronger.
It was, yeah. Surprisingly strong, actually. International SSS grew 7.2% constant currency in Q4. That was the fastest growing piece of the business. And the CEO mentioned something interesting, too, domestically. Both DIY retail and the commercial side improved sort of sequentially throughout the whole quarter.
So things were actually getting better as the quarter went on.
Seems like it. Accelerating, not slowing down. Which, brings us back to that paradox we started with.
Right. Nearly 7% adjusted sales growth. But the bottom line, diluted EPS was $48.71. Okay, fine. But adjusted, that's only up 1.3% from the adjusted number last year. $48.11. That's a huge disconnect. Where did all that sales growth go? Why didn't it flow through to profit?
Well, it wasn't really about sales weakness at all. It's more a story of, let's say, strategic choices and, frankly, some major accounting factors hitting them. We need to look at the margins. The big one, and it's a bit technical, is the gross margin decline. Adjusted gross margin fell about 103 basis points, down to 51.5% in Q4.
Okay, 103 basis points. Why?
The main driver was a huge non-cash LIFO charge. That's last in, first out inventory accounting.
Okay, hang on. LIFO, for anyone listening who isn't deep into accounting, what is that and why did it suddenly cause such a problem this year compared to last?
Right. Good question. It's crucial context. So LIFO is just a way companies calculate the cost of the inventory they sell. Simple version. When your costs are going up, like parts prices have been merged. LIFO makes you expense your newest, most expensive inventory first.
Even if you actually sold older, cheaper stuff?
Exactly. Even if the physical part sold was bought cheaper months ago, it makes your cost of goods sold look higher during inflationary times. And AutoZone got hit with an $80 million LIFO charge in this Q4. Last year, Q4, zero charge.
$80 million, just from an accounting method.
Yep. That one non-cash item knocked 128 basis points off their gross margin. Now, they did actually get better merchandise margins otherwise, but that LIFO swing just completely wiped out the benefit.
So let me see if I've got this straight. It's basically an inflation-related accounting issue, not that they suddenly forgot how to price their products. It sounds like it's mostly on paper.
That's a very good way to put it. It's largely a paper issue. And that paper issue really defined things not just for Q4, but for the entire fiscal year.
Okay, let's zoom out then. Full fiscal year 2025. Adjusted net sales up 4.5%. Healthy enough. But adjusted EPS actually down slightly, down 0.9%. $144.87 versus $146.14 last year.
And guess what? LIFO is the main villain again. For the whole year, they had a $64 million LIFO charge. But in FY24, they actually had a $40 million LIFO benefit.
Whoa, wait. A charge this year, a benefit last year.
Exactly. That's a swing of $104 million year over year purely from that accounting choice. It cost them about $2.84 in EPS for the full year. Without that, EPS growth would have looked, much healthier.
That's incredible. Just an accounting standard causing that much difference. Okay, so beyond LIFO, What else pressured the margins? You mentioned strategic choices, spending money.
Right, that's the operating expense or OPEX side. The OPEX ratio went up too by 53 basis points adjusted to 32.4% in Q4. Management was upfront about it. They said it was driven by investments to support growth initiatives.
So spending money to make money later, essentially.
Precisely. They're consciously spending more now on things like labor, distribution, all the stuff needed to build out capacity for future growth. They're trading some margin today for, hopefully, more market share tomorrow. Oh, and we should also mention foreign exchange rates didn't help either. It took about $14 million off EBIT in Q4.
Okay. So we've got the LIFO accounting hit and deliberate spending on growth. Let's talk about that growth. What are these big strategic initiatives that they think are worth sacrificing current profit for? Where's the money going?
They talk about three main areas, but the two really getting the big push are U.S. commercial that's selling to professional mechanics, the do-it-for-me or DFM market, and international expansion.
Commercial first. That's usually seen as a better business than just selling to DIRs.
Right.
More reliable, maybe higher margin?
Generally, yes, and they saw good acceleration there. Domestic commercial sales grew 6.0% in Q4. That's about $1.76 billion just in the quarter. They're really trying to become the go-to supplier for mechanics, and they're putting the infrastructure in place. They now have commercial programs in 92% of their U.S. stores. That's almost 6,100 stores.
Wow, give me all of them.
Yeah, and it seems to be working. The average weekly sales per program jumped 9.0% in Q4. That shows they're getting more business from each mechanic they serve. Their whole strategy revolves around these hubs and mega hubs, bigger distribution points that let them stock way more parts and deliver them faster. Better assortment, better coverage. That's the goal for both commercial and DIY, really.
Makes sense. And then international. We saw the strong SSS number there earlier.
Yeah, international is really proving itself as a key growth engine. That 7.2% SSS growth in Q4, constant currency. And for the full year, it was even better, 9.3%.
9% growth for the year internationally.
Yeah, high single digits, constant currency. It really suggests the AutoZone model works well in places like Mexico and Brazil. They're executing well there.
Okay, so commercial focus, international expansion. But you mentioned infrastructure, hubs.
Yeah.
That means building things, right? Stores.
And this is maybe the most striking part of the whole report. The pace of expansion. In fiscal 25, they opened 304 net new stores globally.
Wait, 304 net. That sounds like a lot. How does that compare?
It's huge. It's a 42.7% increase in the number of stores they opened compared to the year before. This isn't tweaking the strategy. This is like stepping on the gas hard.
43% more store openings. Good grief.
Yeah. Just in Q4 alone, they opened 141 net new stores. And look, internationally, 45 new stores in Mexico. That grew their Mexico store count by over 11%. 6 new ones in Brazil, that's almost a 16% increase there.
16% growth in Brazil stores in 1 year.
Yep, they're serious. Total store count is now up to 7,657.
So, okay, what does this all mean? Clearly, they're prioritizing this massive physical build-out, even if it dings profits now. But shareholders want returns. How do they balance that huge spending with keeping investors happy?
Well, their capital allocation plan is pretty clear. First, invest in the business, that's the 304 stores, the hubs, etc. But second, return any excess cash to shareholders. And they did that primarily through stock buybacks. Despite the LIFO hit and the heavy spending, they bought back $1.5 billion worth of their own stock in fiscal 25. That was about 447,000 shares.
Huh. $1.5 billion on buybacks when margins are under pressure from spending and accounting. Isn't that just sort of financial engineering to boost the EPS number, to hit that consistent, steady EPS growth goal they talk about?
Well, yes and no. I mean, it definitely is a tool to manage the EPS number, absolutely. By reducing the number of shares outstanding, the share count was down 3.1% for the year. Each dollar of earnings gets spread over fewer shares, which pushes the EPS figure up.
Right. Makes the math look better.
It does, but it's also a standard and, frankly, effective way for mature companies to return capital. So it's partly financial management, partly shareholder return. It helps smooth out the bumps from things like LIFO and heavy investment periods. It's kind of core to how they operate. Invest big, but try to cushion the blow for shareholders.
Okay, makes sense. Let's quickly touch on the balance sheet then. All those new stores must show up there.
They do. Property and equipment net value is up 14.2% year over year. That's the direct result of building all those stores and distribution centers. And inventory is way up too. Total inventory increased 14.1% compared to last year.
14% more inventory. That sounds like a lot too. tied to the new stores.
Directly tied to them, yeah. And stocking those hubs for the commercial business, inventory per store is up 9.6% to about $918,000. And because they're stocking up so fast, inventory turns slowed down just a little bit, from 1.5 times a year to 1.4 times.
Okay, slower turns, more stock. Is that a worry?
Normally, you'd watch that closely. But here's the aha moment on AutoZone's balance sheet. While gross inventory is up, they operate with something called negative net inventory.
Negative. Net inventory. How does that even work? Net inventory is inventory minus what you owe suppliers, right?
Yeah.
Accounts payable.
Exactly. And for AutoZone, it's negative $131,000 per store.
So they owe their suppliers more than the value of the inventory they have on hand.
Precisely. It's a huge sign of efficiency and market power. It means they get such good payment terms from suppliers that the suppliers are essentially funding their inventory.
So AutoZone collects cash from me when I buy a part today,
Right. Gets your cash immediately.
and then pays the supplier maybe weeks or months later.
You got it. That frees up their cash to do things like, well, build 304 new stores without having to borrow as much or dip into other funds. It's a massive competitive advantage, a hallmark of a really dominant, efficient retailer.
Okay, let's wrap this deep dive up. So, summarizing, we've got a company, AutoZone, with really strong underlying sales momentum. Commercial and international are firing on all cylinders. But that momentum is being masked, you could say, by two big things. First, that temporary non-cash LIFO accounting hit from inflation.
Right, a big paper drag.
And second, a very deliberate, very expensive strategic bet accelerating store openings by over 40% to grab market share.
Yeah, the key takeaway for listeners is definitely look past just the headline numbers here. This report shows a management team really going for broke on expansion. They're spending heavily now to build out their footprint, especially for that commercial business, but they're also trying to balance it by returning a lot of cash via buybacks, $1.5 billion worth. It's a conscious trade-off, short-term margin pain for hopefully long-term dominance.
They keep saying their strategy relies on a relentless focus on execution. So here's the final thought. With that inventory jumping 14%, and turns slowing slightly because of this big expansion, how fast does AutoZone really need to execute? How quickly do they have to turn all those parts in all those new stores and hubs into actual sales, especially to those valuable commercial customers, to make sure this hugely expensive bet on physical stores pays off big time in the coming year? Something to watch as they head into fiscal 26.